Silver. We have overlooked its value for many years, while all eyes were fixed on gold. As the ultimate symbol of safety and value storage, silver was quietly treated as a secondary metal, something in the background, less noticed, less discussed. But as industry has advanced to its current stage, everything has begun to reverse. Electrification, electric vehicles, renewable energy, artificial intelligence, data infrastructure, none of these run on gold. They run on silver. And at precisely that moment, silver returns, not as jewelry or a defensive asset, but as an investment wave driven by real demand. The paradox lies here. Silver influences things far larger than itself. Not just the price of a metal, but production costs, supply chains, inflation, and ultimately the entire market economy. And just as silver becomes this important, China begins to tighten its control. Quietly, without loud announcements. Simply through technical regulations, enough to slow the global flow of silver. It may sound like just a commodity story. Perhaps. But when you look more closely, you realize this is not a story about silver prices rising. This is a story about how a small metal can make the entire economic system more volatile than ever. Before going further, one thing must be made clear. This is not a video predicting silver prices, and certainly not a call to buy or sell any asset. If you are looking for an answer like, how high will silver go, you may be disappointed. This analysis is really about mechanisms. About how a seemingly small resource can become a lever of power when it sits at the intersection of industry, money, and geopolitics. Silver is simply the clearest example through which to see this. In other words, silver is not the center of the story. The system is. A system that is becoming increasingly dependent on inputs whose supply is no longer free, no longer flexible, and can be controlled through administrative decisions. Silver is not the story. Silver is the symptom. And for that very reason, if we look only at price charts, we will miss the most important part, the part that very few people articulate clearly. When silver prices begin to rise sharply, the familiar narrative immediately appears. Charts, ETFs, speculative flows, and fear of missing out. The media talks endlessly about price, but says very little about flow. And it is precisely in that gap that the real story lies. Because if you take your eyes off the chart for a moment, you will see a different reality. Most of the world's silver is not mined for silver. Roughly 3/4 of production comes from copper, lead, and zinc mines. Silver is merely a byproduct. That means higher silver prices do not automatically lead to higher output. This supply machine does not respond quickly, is not flexible, and cannot simply be pumped up to meet demand. At the same time, industrial demand is rising exponentially. Electronics, electric vehicles, solar energy, data centers, AI, these are not short-term cyclical demands. These are multi-year, multi-decade projects with long-term contracts and fixed capital plans. When these industries need silver, they must have silver, regardless of price. And then there is a detail that receives little attention. Silver prices in Asia are higher than in the West. This creates a very natural arbitrage flow. Physical silver is bought in London and New York, then flows eastward. More strikingly, the largest destination of that flow is China, which is preparing to impose tighter export regulations. Imagine a store that remains open as usual, but whose goods are quietly moved out every night. No one shouts. No one closes the doors. Yet the shelves grow emptier by the day. The most dangerous thing is not rising prices. It is the moment when you need something and cannot buy it. And once we understand this, we are forced to ask, if this is not merely a story about prices, where is this flow taking us? To avoid being swept away by isolated details, we need to view this story as a continuous flow, where each link naturally leads to the next. It begins with a seemingly harmless shift. Silver gradually moves away from its role as a speculative precious metal and slides into the position of an infrastructure metal. As the world electrifies everything, from transportation and energy to data, silver becomes a mandatory material with few immediate substitutes. Demand therefore no longer flexes with price, but clings tightly to long-term production and investment plans. But supply stands still, not because there are no mines, but because of the structure of extraction. When silver is primarily a byproduct, the system cannot respond quickly to a single price signal. This creates a dangerous lag between demand and supply. In that gap, physical flows begin to shift. Silver does not disappear. It simply changes direction. From traditional financial centers, it quietly flows toward places willing to pay more, and more importantly, toward places with long-term strategies for its use. And at the intersection of all these factors, we see the role of China, not as a shock-inducing market disruptor, but as the one adjusting the flow valve. Simply by changing licensing conditions, the entire system downstream immediately feels the pressure. Nothing in this process is accidental. It is just that very few people connect the steps together. When you connect them, the story is no longer confusing. And at that moment, the system's truly powerful moves begin to reveal themselves. At this point, if we stop at silver is becoming scarce or silver prices are surging, we are still viewing the story at a very shallow level. The more important part lies in how the system responds, and does not respond, to this change. It is precisely there that structural moves start to emerge. The first point that must be confronted directly: silver is no longer an optional metal. For many decades, silver could be seen as a metal with both ornamental value and industrial applications. But now, in the context of electrifying the entire economy, silver has become a mandatory input, not because it is the rarest, but because it is the best at what it does. As the metal with the highest electrical conductivity, silver appears in places where performance cannot be compromised: circuits, switches, high-performance batteries, solar panels, data centers, and AI infrastructure. This creates a subtle but critically important shift. Demand for silver no longer reacts strongly to price. An electric vehicle manufacturer or a data center cannot simply halt production because silver has become more expensive. Silver costs may rise, but without silver, the product does not exist. And when demand is inelastic, every supply shock is amplified. Next comes the supply issue, the part many people tend to underestimate. Most assume that higher prices will bring more mines and more output. But silver does not work that way. Approximately 75 to 80% of global silver production comes as a byproduct of copper, lead, and zinc mining. That means decisions to increase or decrease silver output are not controlled by the silver market itself, but depend on demand and profitability for other metals. Even the 20 to 25% of silver that comes from primary silver mines does not make the situation much more flexible. From discovering a new deposit, securing permits, building infrastructure, to producing the first ounce of silver, it often takes more than a decade. In other words, silver supply is effectively locked in during the very time frame when demand is rising the fastest. This is a structural bottleneck, not a cyclical one. When demand rises faster than supply over a prolonged period, the system naturally seeks balance through physical flows. And here, a rarely discussed phenomenon becomes crucial: geographic arbitrage. When silver prices in Asia are higher than in London or New York, holders of physical silver do something very simple: buy where it is cheaper and sell where it is more expensive. This is not a conspiracy, it is a market reflex, but its consequences are systemic. Physical silver, already scarce, begins to leave Western financial centers, where it had long been treated as liquid reserves, and flows toward manufacturing hubs. More notably, that flow is directed toward China, where silver is not only consumed but integrated into long-term industrial strategies: solar energy, electric vehicles, next-generation batteries, and data infrastructure. The problem is this: once silver enters those production chains, it almost never returns to the free market. Unlike gold, silver is consumed. It is soldered permanently into circuit boards, dispersed throughout devices, locked into infrastructure. This means that, on paper, inventories may still appear to exist, while real physical inventories become increasingly thin. And this is where another move of the system is revealed: the separation between the paper market and the physical market. For many years, silver, like many other commodities, has been traded primarily through contracts, ETFs, and derivative instruments. On paper, liquidity appears abundant. But when demand shifts from financial holding to physical delivery, the imbalance ratio begins to look alarming. Some estimates suggest that the ratio of paper silver to physical silver runs into the hundreds to one. That does not mean the system will collapse immediately, but it raises a very sensitive question. What happens if too many people at the same time want to touch the real asset? At that point, the issue is no longer how much it costs, but whether it is available at all. At this stage, administrative decisions become a lever of power. When a country controls large portions of the supply chain and applies strict licensing conditions, it does not need to issue hardline declarations. Simply raising standards, lengthening procedures, or prioritizing domestic use is enough to slow global flows instantly. There is no media shock, yet pressure spreads through every link in the production chain. What is striking is that all of this is happening in a global economy that is already highly sensitive to input costs. A silver increase of just a few percentage points can raise production costs across multiple industries. Not in a simple silver price up equals product price up way, but through a tightening at one link that forces the entire chain to adjust. Manufacturers raise prices, retailers adjust margins, and end consumers bear the remainder. Here, silver is no longer a story for metal investors. It becomes a contributor to cost-push inflation, something that has already been troubling central banks. And when inflation returns, the narrative naturally extends into money, interest rates, and public debt, areas where the current system is already stretched taut. Hearing this, you might think, so is this a silver crisis? Not exactly, and that very thought is a cognitive trap. This is not a crisis caused by silver. Silver is merely the place where accumulated pressure becomes most visible. It is like a weak point in a dam wall. The water does not originate there, but when pressure grows large enough, that is where the first cracks appear. This is not a shortage of silver. It is a shortage of free access to silver within a system that is becoming increasingly dependent on it. And when you look at the story that way, you begin to realize what is happening with silver is not an exception. It is a pattern that, in the coming years, may repeat itself with many other strategic resources. At this point, if we stop at supply and demand analysis alone, we still have not reached the core. Because the larger question is not how much higher can silver go, but rather, why is the current system so vulnerable to pressures that appear so small? To answer that question, we need to shift our perspective, not to view silver as the cause, but as a switch that has just been flipped, revealing pressures that have existed within the system for a very long time. Here, there is an easy mistake to make, assuming that silver is the cause of all the volatility we are seeing. But if you look more closely, you will see the opposite. Silver does not create pressure. It is simply where pressure is forced to surface. The tensions we are observing, persistent inflation, rising production costs, fragile supply chains, expanding public debt, all existed beforehand. Silver merely happens to sit at the intersection of all these forces. When an input is both industrially indispensable and constrained in supply, it becomes a switch for the system. Observe how the reaction propagates. When silver becomes scarce, manufacturers do not shut down immediately. They absorb higher costs. That compresses profit margins. To compensate, prices are adjusted upward. Higher prices feed into inflation indices. Inflation then puts pressure on interest rates. Higher interest rates raise borrowing costs for governments and businesses. And at the end of that chain lies public debt, something that was already at a highly sensitive level. In this chain reaction, silver does not cause anything. It merely triggers a series of responses that were already primed, like a light switch in a room filled with overloaded equipment. Flipping the switch does not create the electricity, but it reveals how much strain the system is under. This is also why precious metals often appear during periods of systemic stress, not because they are magical, but because they reflect monetary imbalance. When confidence in fiat money weakens, or when the real costs of production rise faster than incomes, capital tends to seek more tangible forms. Silver does not cause a crisis. It simply turns on the light to show that the room has become too hot. And once you see it that way, the story of silver is no longer an isolated one. It becomes a sign that the current system is operating close to its limits, and that only one more small change at any link in the chain could cause everything to shift very quickly. Imagine the entire economy as an old electrical network in a building that has been patched and renovated over many decades. At first, the system only needed to supply enough power for lights and a few basic devices. But then, floor by floor, new loads were added: air conditioning, elevators, servers, electric vehicle chargers, data centers. Each time the building expanded, no one replaced the entire wiring system. They simply added more connections, patched more lines, and endured a bit more strain. In that electrical network, Silver is like a fuse. Small, cheap, and rarely noticed. It does not generate electricity. It does not decide how many devices you use. But when the load becomes excessive, the fuse is the first thing to heat up. When the fuse starts to squeal, the typical reaction is to replace it with a new one or find ways to temporarily fireproof the system. But the problem was never the fuse. The problem lies in a system that has been stretched far beyond its original design. The story of silver is the same. Silver does not overload the economy. Electrification, globalization, financial leverage, and public debt are what do that. Silver simply happens to sit in the right place to reveal that the load has exceeded safe limits. You do not fix an overloaded electrical network by yelling at the fuse. And if this metaphor holds, then the real question is not how long the fuse will last, but how many similar weak points exist within the system that we have not yet recognized. After viewing silver as a switch within the system, it is important not to fall into the trap of premature conclusions. Markets do not operate according to a single script, and what is happening now could branch in many different directions, depending on future conditions. If global industrial growth slows, especially in silver-intensive sectors such as electric vehicles, solar energy, or data centers, demand pressure may ease. In that scenario, silver prices do not need to continue rising, even if supply remains relatively rigid. The system simply becomes less strained. If substitute technologies advance faster than expected, such as new conductive materials or optimized designs that reduce the amount of silver required per unit of output, the mandatory role of silver could gradually erode. This will not happen overnight, but it is a variable that cannot be ignored. Conversely, if geopolitical tensions persist, if export controls are expanded or applied to additional resources, or if inflation returns more forcefully than expected, silver may continue to be a point where pressure converges. In that case, volatility will arise not only from supply and demand, but from the defensive psychology of capital flows. The most important thing to remember is this: no scenario is certain. Markets rarely follow the path that the majority expects. What looks like a clear trend today can be reversed tomorrow by a policy change, a technological breakthrough, or an unexpected economic slowdown. Markets do not reward certainty. They reward those who understand the conditions that lead to outcomes. So instead of asking, where will silver go? A better question is, which conditions are changing, and how will they push the system? If this story is not meant to answer, should you buy or sell silver, then its real value lies elsewhere, in the signals that help you read systemic pressure before it appears in headlines. These are not checklists for rushed action, but observation points to help you stay alert. The first signal lies in export and licensing policies, not only for silver, but across the entire group of strategic resources. Small changes in conditions, approval timelines, or technical standards often arrive quietly, yet speak louder than political statements. When procedures become slower and more complex, it is often a sign of domestic prioritization. The second signal is real industrial investment demand, especially in silver-intensive sectors, electric vehicles, solar energy, data centers, and AI infrastructure. Not PR news, but capital expenditure data, long-term orders, and capacity expansion plans. When these projects are delayed or cut back, demand pressure can cool far faster than many expect. The third signal comes from physical inventories, particularly at traditional trading hubs. Inventories that decline slowly but steadily are often more telling than sudden drops. They indicate that flows are leaving, rather than merely reflecting short-term volatility. The next signal is the gold-silver ratio. Not to predict prices precisely, but to understand capital psychology. When this ratio shifts rapidly, it often reflects a change in how investors perceive monetary risk and growth. Finally, there is currency strength and real interest rates. When real rates remain negative for extended periods or confidence in fiat money weakens, tangible assets tend to be reassessed, not because of profit expectations, but because of defensive needs. Signals always appear before headlines. They are simply not packaged neatly for you. Watching these signals will not help you avoid volatility, but it will help you avoid being surprised when volatility arrives. And in an increasingly sensitive system, that alone is a significant advantage. If you have made it this far, you have likely realized that this story was never only about silver. Silver is merely the starting point. a clear enough example to show how accumulated pressure within a system finds a place to surface. And when it does, it rarely stops at just one point. What is worth reflecting on is this: silver is not the only resource with these characteristics. The modern world is becoming increasingly dependent on very specific inputs that are difficult to substitute and not easy to expand in supply. If even one of them is tightened, the entire downstream chain must immediately adjust. So the question is not where silver is headed. The question is, how many other silvers are there in the system that we have not yet seen? How many bottlenecks already exist, simply waiting for a small change in policy, technology, or geopolitics to be revealed? And when that happens, do you want to be the one who is caught by surprise, or the one who has already understood the mechanism and is merely observing the signals? I would really like to hear your perspective. Which resource, industry, or link do you think could become the next switch of the system in the coming years? If you have stayed with me to this point, you may also sense what this video is aiming for. Understanding mechanisms is always more important than chasing predictions. Markets may rise, they may fall, but the pressures beneath the system usually surface long before they become major headlines. If you are interested in how money, resources, public debt, and power intertwine, not through confident assertions, but through quiet connections, you may consider subscribing to the channel. Here, we are not trying to predict the future. We are learning how to observe the system as it changes. In the next video, I will go deeper into the relationship between strategic commodities, money, and public debt, and why small bottlenecks are having increasingly large impacts in a globalized economy. If you find analyses like these help you see things more clearly, stay with us. Because in an increasingly complex world, understanding how the system operates is already a rare advantage.